All right, let's talk about new home loans. Something's definitely brewing under the surface. While everything might seem okay on the outside, a new industry report has uncovered a trend that's, well, it's a little worrying. So today, we're going to break down what's really going on with mortgage quality. So here's the deal. After a pretty calm stretch, the quality of new mortgages is suddenly under a microscope. Why? Because the number of serious errors, what the industry calls defects, is ticking up, and that's got everyone paying very close attention. And that, of course, leads to the big question we're tackling here. With all the tech and all the checks and balances we have now, how is it that these serious errors are actually on the rise? And you know what? The answer is way more interesting than you might think. Okay, so let's start with a big picture. The headline numbers from the second quarter of 2025 that first set off the alarm bells. And there it is. The overall critical defect rate climbed to 1.51%. Now I know, that sounds like a tiny number, right? But you gotta remember, in an industry that's moving billions and billions of dollars in loans, even a small percentage like that represents a huge amount of risk. And this wasn't just some random one-time blip. It jumped up from 1.31% in the first quarter. That makes it the second quarter in a row that the rate has gone up. And that right there is when you know you're looking at a trend, not just a fluke. And just so we're all on the same page, let's be super clear about what a critical defect is. We're not talking about a simple typo on page 50. This is a significant, major error in a loan file, something so serious it could make that entire loan uninsurable or even impossible for the lender to sell. These are the mistakes that carry some very real financial punches. But, and this is a big but, that headline number really doesn't tell the whole story. In fact, when you dig into the data, you find a pretty surprising twist. And the report's author, Nick Volpe, points this out himself. He says the situation is nuanced. And that's exactly what we're going to unpack right now. Because the reason for this increase is not at all what you'd expect. So if you just glance at this chart, you might think, oh, okay, same old story. Problems with verifying a borrower's income and employment are still the number one cause of defects, making up over 18% of all the errors. And yeah, historically, that's always been a huge headache for quality control. But here comes the twist I was talking about. Even though it's still the biggest slice of the pie, the share of defects from income and employment issues actually dropped, and by a lot. It went from almost 23% in Q1 down to about 18.5%. So the area that has always been the biggest problem is actually getting better. Which naturally leads us to the real mystery here. If the most common type of error is actually improving, then where on earth is this overall increase in defects coming from? What's getting worse? Well, this is where we solve that mystery. We're about to pinpoint the exact areas that are driving that top-line number up. And boom, here it is. Just look at these surges. Appraisal defects, they more than doubled. Borrower eligibility defects, they also more than doubled, jumping from just under 7% to almost 16%. And get this, property eligibility issues went from literally 0 in the first quarter to over 4%. These three categories, these are the culprits. So to put it another way, the problem isn't about whether people can prove they have a job and can make their payments. No, the growing issues are all centered on the property itself, its value, its condition, and on whether the borrower and the property technically qualify for that specific loan program. Okay, so now we know what's getting worse. The next logical question is, why? And the answer has everything to do with one specific kind of loan that saw a massive spike in popularity. And we're talking about the cash-out refinance. You probably know what this is. It's when a homeowner refinances for a bigger mortgage than what they owe, pays off the old loan, and then gets to pocket the difference in cash. It's a super popular way to tap into your home's equity. And in the second quarter, market conditions created the perfect storm for these loans. See, the overall market picked up a little, which is normal for the season, but refinance lending just exploded, growing 27% from the last quarter. Why? Well, there were these brief dips in interest rates, and homeowners jumped at the chance to pull cash out of their homes. And right here, folks, is the smoking gun. This chart connects all the dots perfectly. While refinance loans made up just over 17% of all the loans that were looked at, they were responsible for a whopping 26% of all the critical defects. So yeah, they are punching way, way above their weight when it comes to errors. So let's pull this all together. What does this really strange mixed bag of data actually mean for the housing market as a whole? Here's the bottom line. Yes, the overall defect rate is up. But, and this is important, lenders are actually getting better at the traditional stuff, like verifying income. The increase is being driven almost entirely by these appraisals and eligibility issues, which are directly tied to that surge in cash-out refinances. It's not a sign that loan quality is collapsing everywhere. It's a sign that the market is in flux.
So the big takeaway here, and the main point the report makes, is that quality control can't be a one-size-fits-all kind of thing. As the market shifts, like it just did with that refi boom, lenders have to be smart and shift their focus to where the new risks are popping up.
And all of this leaves us with one final big question. This data clearly shows a market that's changing. But is this spike in appraisal and eligibility problems just a temporary blip tied to a short-term refinance trend? Or is it the beginning of a brand new headache for lenders? Well, for that answer, we're all going to have to wait and see what the next quarter's data tells us.